All right, let's get right to it. Tonight, every single eye in the financial world is locked on Washington. The Federal Reserve is on the verge of a decision that is going to dictate the market's direction for months, maybe even into the new year. Now, this isn't just another routine meeting. No, this is what we call an inflection point, and it has the potential to unleash some serious volatility. So let's break down what's on the table, what the Fed is looking at, and most importantly, lay out a clear playbook for how you can position yourself for whatever comes next.
You know, this quote really nails the feeling in the market right now, doesn't it? It feels like an ocean right before a big storm. On the surface, things might look kind of calm, but underneath, you can feel these powerful currents building. The Federal Open Market Committee is about to make its call, and everyone from Wall Street pros to retail investors are holding their breath, bracing for the waves. The real question isn't just what they're going to do, it's about the ripple effects that are going to spread through every single asset class.
So to really get a handle on what the Fed might do, you first have to appreciate the incredible pressure they're under. I mean, they are trying to navigate through a complete fog of contradictory economic signals. It's like they're trying to steer a massive supertanker, and every tiny adjustment to the wheel could have these enormous, unforeseen consequences down the line.
And here's the heart of that foggy dilemma. It's a fundamental tug-of-war. On one hand, you've got inflation. Yeah, the CPI has cooled off to 3%, which is way better than the scary highs we saw in 2022. But it's still stubbornly above their 2% target. That screams, hold the line, don't cut yet. But then you look at the other side, the labor market, and it's just confusing. Unemployment is ticking up, but jobless claims are low. The private sector actually lost jobs, but other parts of the economy look strong. So what do? Do you cut rates to prop up the job market, or do you stay tough to kill that last bit of inflation? That is the impossible choice they're facing right now.
But here's the fascinating part. Despite all that confusion, the market, well, it seems to have already made up its mind. If you look at the CME Fed Watch tool, and believe me, every trader is watching this, it's showing that the market is priced in something like an 85 to 90% probability of a 25 basis point rate cut. So the market has placed its bet. It's a huge one, and it's saying, we expect you to cut.
Okay, and this brings us to what I believe is the single most important point of this entire briefing. The action itself, the actual rate cut, might not even be the main event. What truly matters is the message that comes with it. We could be staring down the barrel of what's called a hawkish cut. Think about that. It's where the Fed gives the market the cut it's screaming for, but they pair it with a really tough cautionary message. They might say, okay, here's your cut, but don't even think about asking for another one anytime soon. That message could come through in their dot plot projections or just in Chairman Powell's tone at the press conference. And that is the real volatility trigger that could catch everyone off guard.
So with that backdrop, how are the big asset classes getting ready for this? It's honestly like watching a fascinating ballet. You've got gold, silver, and Bitcoin, and they're all moving in their own unique way, but they're all dancing to the same music being played by the Fed. Let's start with gold, which has had a truly phenomenal year. We're talking about it rocketing up to all-time record highs over $4,300. This incredible surge is being powered by two massive engines. First, you have the market betting on lower rates, which makes holding a non-yielding asset like gold way more attractive. But second, and this is a huge long-term structural shift, we're seeing central banks around the globe buying gold at a record pace. They're trying to diversify away from the US dollar. It's a perfect storm of a flight to safety and a major strategic pivot.
Now, if you think gold's run has been impressive, you've got to look at silver. It's actually been outperforming gold, setting its own new records around $59 an ounce. And the reason for this is silver's unique dual personality. It's not just a precious metal, a safe haven asset. It's also a critical industrial metal. I mean, think about it. Solar panels, electric cars, 5G tech, they all need silver. So you have this collision of investment demand and real-world industrial demand, which makes it incredibly explosive.
And of course, we have to turn to the crypto world. Bitcoin has shown some serious strength, clawing its way back into this absolutely critical $90,000 to $95,000 zone. Now, from a technical perspective, this is a major battleground. It's pushing up against what traders call a dense wall of resistance, a price level where a lot of selling has happened before. So the sentiment is really on a knife's edge. You have the excitement about easier money pushing it up, but you also have the caution of this technical ceiling, which could lead to a classic sell the news event.
To really get why Bitcoin moves so violently around these Fed meetings, you have to understand one key concept: liquidity beta. Let me break it down. Assets like Bitcoin are hypersensitive to the total amount of money or liquidity sloshing around the financial system. So when the Fed starts to ease up, when they cut rates, it's like they're turning on the money spigot full blast. That unleashes Bitcoin's liquidity beta, and you get these incredibly powerful, fast moves. It is the core mechanism to watch in the hours after the announcement.
Now look, nothing ever happens in a vacuum in these markets. The best way to understand where we might be going is to look at where we've been. History gives us a couple of really powerful case studies here, specifically the cycles in 1998 and 2019 when the Fed was in a similarly tight spot.
Back in 1998, the world was on edge. You had the Russian financial crisis, the collapse of the giant hedge fund LTCM. It felt like the system was about to break. The Fed jumped in with 3 surprise rate cuts. We now call those insurance cuts. They were acting to prevent a disaster. Then you fast forward to 2019. The Fed did what it called a mid-cycle adjustment. It was a few cuts, but they made it very clear this wasn't the start of some massive easing cycle. It was just a little tune-up. In both cases, the market's reaction hung entirely on how the Fed framed its actions.
And I actually remember that 1998 period very well, sitting on a trading desk. When the news of that first emergency cut hit the wires, the initial reaction was just a violent, purely liquidity-driven explosion. Bond yields just collapsed, but the stock market, it actually stayed weak for another week, until the panic really died down and investors understood what the Fed was trying to do. The lesson from that time was seared into my brain. Raw liquidity drives that first knee-jerk move, but it's the market's expectation of what comes next that builds the real, lasting trend.
And that really brings us to the key lesson from history. The market tends to react incredibly well when it believes the Fed is making a confident, limited adjustment, what we call a cut and pause. It's seen as a sign that they're in control. But if the market gets a whiff that the Fed is cutting because it's panicking about a recession on the horizon, that's when you see risk assets really take a nosedive. That message of "we've got this" is everything. Okay, so we've done the analysis. Let's pivot now and get practical. It's time to go from theory to action. What I want to give you now is a clear 7-step playbook to help you navigate the coming volatility. Think of this as your chart for these potentially stormy seas. The first 4 steps are all about getting prepared before the chaos hits. Step 1, build your dashboard. That means having the Fed watch tool, the dot plot, and the US dollar index up on your screen. These are your real-time navigation tools. Step 2, position yourself for the most likely outcome, which we believe is that cut and pause scenario. Step 3, be disciplined. Know your key price levels for gold and Bitcoin before the news. And step 4, and this is absolutely non-negotiable, manage your risk. That means check your leverage, know your position sizes. Don't be a hero. All right, now let's talk execution. Step 5 is simple, but so many people get it wrong. Know the timeline. The rate decision drops at 2 p.m. Eastern, but the real fireworks often start at the press conference at 2:30. Step 6, for the active traders out there, use a system. Something like an R-multiple method helps you to find your exact risk and reward before you even click the button. And finally, step 7, always have a plan B. What are you going to do if we get that hawkish surprise? You need that plan locked and loaded before the event, not while you're scrambling in the middle of it. Let's make this real with a quick, hypothetical trade on Bitcoin using that R-multiple method. Let's say we get our bullish cut and pause scenario, and Bitcoin breaks out above 94 grand on good volume. Okay, you could set an entry at, say, $94,200. Your stop loss goes in at $92,800. That distance, $1,400, is your 1R, 1 unit of risk. So your first profit target might be at $97,000, which is a gain of $2,800, or 2R. At that point, you could sell half and move your stop to break even, making it a risk-free trade. See, it's a system. It takes the emotion out of it. So as we pull all of these different threads together, what's the most likely path forward? Let's distill all of this down into a really clear final outlook so you know exactly what to watch for when the headlines start flashing. When it comes down to it, there are really 2 main scenarios on the table. Scenario 1, our cut and pause, is the bullish path. That's generally good for stocks. You'd see gold consolidate around these new highs, and for Bitcoin, it would need to punch through that resistance to really confirm the next leg up. Then you have scenario 2, the hawkish cut. That would be the signal to get defensive. We'd probably see a quick dip in gold, and Bitcoin would likely pull back to retest its lower support levels, maybe somewhere in that 84,000 to 88,000 range. And it is so important to remember that this isn't just a U.S. story. Whether you're investing from Saigon, London, or anywhere else, the Federal Reserve's decisions effectively set the price of money for the entire world. It directs the flow of capital, it determines risk appetite everywhere. Those record-high local gold prices you might see in Vietnam, they're directly tied to these global movements.
The direction of the S&P 500 sets the tone for stocks globally. Your portfolio is plugged into this global circuit board, whether you like it or not.
So if I can leave you with one final crucial variable to watch, it's this. The rate cut itself matters, of course. But I would argue that more than half of the market's reaction tonight is going to depend not on the action, but on the language. It will all come down to Chairman Powell's tone, the nuances in his answers, and the subtle signals buried in the Fed's statement. In this environment, communication is policy.
We started this whole discussion by talking about the market as an ocean, waiting for a storm, while the Fed is about to make the wind blow. The waves are about to get stirred up. Now, we can't control the storm, but we can absolutely control our own ship. We can prepare, we can have a solid plan, and we can navigate with discipline. So the only question you should be asking yourself tonight is this: is your ship ready?